Welcome to the International Accounting Channel. Remember to subscribe to the channel, like, share your opinion. Together with us to answer multiple choice questions about international accounting. Now, let's get started. On January 15, 2014, MTJ Company shipped goods to the agent for sale. On January 15, 2014, the agent received the goods and sold the above goods on February 7, 2014. On February 15, 2014, MTJ received the agent's sales report. According to the periodic inventory method, MTJ's accountant will record the cost of goods sold on A. January 15, 2014. B. February 7, 2014. C. February 15, 2014. D. February 28, 2014. February 28, 2014. When a business generates a sale transaction to a customer using the consumption method with a buyback contract, the accountant will record A. Increase sales revenue, B. Increase payables, C. Increase expenses, D. Increase owner's equity. D. Increase payables. According to the regular declaration method, at the end of the accounting period, the cost of goods sold account will have the following structure. A. There is a balance on the credit side. B. There is a balance on the debit side. C. There is no balance. D. There is a balance on the debit and credit sides. C. There is no balance. MTJ Company manages inventory using the periodic inventory method. On January 1, 2014, the value of inventory at the beginning of the period, $34,000. Total value of goods purchased during the period, $165,000. On January 31, 2014, according to the inventory results, the value of inventory, $45,000. The accountant transfers the cost of goods sold. A. Debit determining business results account $156,000. Debit merchandise account $9,000 per credit purchases account $165,000. B. Debit determining business results $165,000 per credit merchandise account $9,000. Credit purchases account $156,000. C. Debit determining business results account $165,000 per credit merchandise account $165,000. D. Debit determining business results account $165,000 per credit purchases account $165,000. Debit determining business results account $156,000. Debit merchandise account $9,000 per credit purchases account $165,000. On September 27, MTJ Company transferred 1,000 products to AB Company for a short-term loan of $105,000 for a term of 2 months, with an interest rate of 2% per month, and a storage cost of $300 per month. On September 27, MTJ accountant reflected a debit cash account, $105,000 per credit sales revenue account, $105,000. B debit cash account, $105,000 per credit short-term loan account, $105,000. C debit cash account, $105,000 per credit merchandise account, $105,000. D debit cash account, $105,600 per credit short-term loan account, $105,600. E debit cash account, $105,000 per credit short-term loan account, $105,000. According to the consumption method with a purchase return contract, at the time of receiving the goods back, in addition to the principal debt payable, the enterprise will have to pay the customer A. Storage costs. B. Interest costs. C. Storage costs and interest costs. D. Commission costs. C. Storage costs and interest costs. On January 3, 2014, MTJ Company delivered goods to the agent. On January 5, 2014, the agent received the goods and sold the above goods on January 10, 2014. On January 20, 2014, MTJ received the agent's sales report. MTJ's accountant will record revenue on the date, A. January 3, 2014. B. January 5, 2014. C. January 10, 2014. D. January 20, 2014. D. January 20, 2014. On October 12, the company received $24,000 in advance for a 12-month contract, effective from January N+1. Assume the accounting and reporting period is quarterly. Adjusting entry on March 31, N+1. A. Debit revenue received in advance account $6,000 per credit revenue provided for services account $6,000. B. Debit cash account $24,000 per credit accounts receivable $24,000. C. Debit cash account $24,000 per credit service revenue account $24,000. D. Debit accounts receivable $24,000 per credit cash account $24,000. Debit revenue received in advance account $6,000 per credit revenue provided for services account $6,000. On October 12, the company received $24,000 in advance for a contract to be performed in the next 12 months. The accountant recorded A. Debit cash account $24,000 per credit advance revenue account $24,000. B. Debit cash account $24,000 per credit accounts receivable $24,000. C. Debit cash account $24,000 per credit service revenue account $24,000. D. Debit accounts receivable $24,000 per credit cash account $24,000. Debit cash account $24,000 per credit advance revenue account $24,000. The company is selling a photocopier that originally cost $8,000 and had $3,000 of depreciation. The repair cost before the sale was $200. The customer agreed to buy it for $5,500. Knowing that the additional depreciation before the sale was $100. So this sale generates A. A profit of $500. B. A loss of $500. C. A profit of $400. D. A loss of $400. C. A profit of $400. Thank you for watching our channel. See you again in the next video.